Let's bring in Brian Reynolds. He's Chief Market Strategist at Reynolds Strategy. Brian, welcome. And tell me exactly about sort of how this might play out and the effects on the market and the economy.
Well, I've been on with you the last couple of years saying how complicated this environment is. It's going to become more complicated because we have money market funds surging and bank deposits declining because people are realizing that money market funds yield much more than banks. And so we're seeing a shift. It was a crisis in March when SVB Bank went out of business. But that woke people up to the idea that money market funds yield more. And so we're seeing a transition out of banking into money market funds, and that means less lending for consumers and businesses.
And absolutely. So now that, and you've heard what Barry just said about that, a lot of people, I think, Brian, recognize this dynamic, but some of them remain bullish or sort of look at the stock market and say, OK, well, look what, risk is doing, or OK, well, the Fed's going to respond to this and have to pause. I mean, so kind of play this story out to the conclusion you think it's headed towards.
So the result for stocks has been it's been a choppy environment for the last year and a half. You've had negative things go on, like the bank crisis, like the surge into money market funds, but you've had positive things like companies building up for buybacks. Buybacks don't lead markets, so I think there'll be a negative surprise due to lending from banks. And I want to be a buyer of that surprise because eventually buybacks will take over. I think it's going to be choppy for the next part of this year, but next year I think it'll be a better environment. So I want to be a buyer on weakness. I want to be a seller on strength in the near term, eventually leading to higher stock prices.
I was going to ask about that because so far this year, and we've been talking about going into the summer, your concerns and how you would be selling any rallies. Is that a change of view now? Have we hit an inflection point? And if so, why?
I don't think we've hit an inflection point because all of a sudden with the debt deal, people started worrying about the supply of treasuries that the government's going to start issuing. I think that supply will be overwhelmed by demand because we went on a buyer's strike during the debt ceiling battle. But right now, people in the stock market are worried about that. If they're worried about that, we've seen in the last year and a half, that pushes stock prices down. I want to be a buyer of that. And if we rally too much in the near term, I want to be a seller of that.
So I'm surprised to hear you say that you're a little bit more optimistic as we head into 2024, which is exactly when a lot of people say if we haven't been in recession by then for sure 2024 would be the moment.
Well, I think that'll be a positive surprise. And I think we'll start to see buybacks start to lead because companies have been announcing more buybacks, even as they've slowed their actual buybacks. That buildup of buybacks, I think, will lead us in 2024. But I think we need to get through 2023 first.
Final question, Brian. How did companies behave in terms of buybacks, leaning into them or maybe backing away from them during the financial crisis? Because it's always my understanding that they tend to kind of buy high, not low. And it sounds like you're expecting them to maybe start picking up those buybacks if a recession were to come.
They used to buy high 20 years ago, but in the last decade, they've become laggards. They followed stock prices. They buy when prices go up, but they don't buy when prices go down. So I think if we have a downturn in stock prices, that will slow buybacks even more. But then on the ensuing rebound, I think they'll pick up and lead us into 2024.
Well, that would be a very different and welcome perspective based on what most are bracing for. Brian, thanks for your time today. We appreciate it.